Let's talk about it as we go toward the close of trading on this Tuesday. Is the worst over, or are today's green arrows just a speed bump? Before we continue the selling again, joining us in our Closing Bell exchange today, Christine Short from S&P Capital IQ, Mark Martiak from Premier Wealth Management. They're both with us here at the New York Stock Exchange. There they are. Ryan Dietrich from Schaefer's Investment Research, Michael Robinson from Money Map Press, and of course our own Rick Santelli. Christine, what do you make of this volatility? I mean, there's been an obvious increase in volatility. Is there more to come to the downside, do you think?
You know, despite what the markets have been doing, earnings season has been performing quite well. Right now, S&P Capital IQ has an earnings growth rate of about 7.4%. That's the highest growth rate we've seen in almost 2 years. On top of that, we're seeing beat rates on both the top and the bottom line higher than historical averages. And so we think the 7.4%, remember, we still have about 200 companies left to report, could go up to about 8 to 9%. So as far as earnings are concerned, that's not being reflected in the markets that we're seeing right now, because earnings season is actually historically doing quite well.
How ironic, right?
Yeah, exactly. So, Mark, should people be buying hand over fist here?
Well, I think you should be very careful when it comes to buying. I think if it fits into your asset allocation model and your mix that your advisor's working with you on, I know with my clients, I'm working very closely with them. But yes, when these days, these volatile days appear, this is the time where you want to look at the cash you have on the sidelines and put it to work fairly immediately, because it might be a short pullback, but I see the market climbing higher from here.
And Ryan, you know, it's clear the mentality has changed from 2013 to 2014. Last year, with every dip, everybody was asking, should you buy this dip? Now, when you get a bounce like you have today, people may be wondering, should I sell this bounce if we are fearing going lower? What do you make of the sentiment in the stock market right now?
That's right, Bill. You know, one thing we are encouraged by, a 5.5% dip, and everyone last year said we just want a 5% dip, we're going to buy. Now we have a good amount of fear, so that's positive. You know, one thing, I know 2 weeks ago I was talking with Kelly about the action in the VIX. There were all-time record calls on the VIX. We said, you know, it could be smart money. Looking back 2 weeks later, it absolutely was smart money. But what's neat about the VIX, we're up to that 21 level, you know, just yesterday. Right. Now it's back to 19 today. What's really interesting, though, the calls that we saw are actually starting to go lower. Even though there was record volume on the VIX yesterday on options, calls actually dropped. So now that what was smart money, maybe getting out of volatility, looking for lower volatility, previous peaks in your record VIX options records when there's most option volume, those were near-term bottoms in the S&P 500. So, hey, this is one step in the right direction, I think.
And that's the question on everyone's minds. Rick Santelli, you look at sort of the indicators there, talking about the dollar, about interest rates. Are you gleaning any signals?
Well, actually, to come up with the answer to your question, I'm going to look at stocks. You know, we're up about 80 right now, okay? So we've taken 4 steps down yesterday and 1 step up today, because you have to multiply today's net gains by 4 to basically equal negating yesterday's 300-plus down day. I think we need to always remind ourselves that 2014 isn't like 2013. It shouldn't be treated that way. And when it comes to interest rates, I continue to monitor 2 things. The first thing is the steepness or lack thereof of the yield curve, which has been nothing but flattening for the most part for 2014. So that should keep all the pieces the same. And the other issue is the Nikkei and the dollar yen. You know, the Nikkei's around 14,000. I know it's not having a good year. Well, let's not lose sight. You'd have to take that 14,000 and almost multiply it by 3 to end up at the price we're at just about exactly 25 years ago, just shy of 40,000. We need to keep those big macro views in perspective.
Yeah, a lot of perspective needed when you get a sell-off like this. Michael Robinson, what do you make of what's going on these days in this market at this point? I mean, let's look at the NASDAQ, for example. Technology, I know you like that, but it has been easily the most volatile of the major 3 averages on Wall Street. You still like it despite the tremendous volatility here?
I do. Again, I think stock selection is going to be important this year. We're going to have choppy markets, but it's going to be uptrending. You know, technology as a sector has increased earnings in the 4th quarter by 8.2%. So it's one of the big market leaders. And the untold story, to piggyback off of what one of your earlier guests said, is technology as a sector is doing very, very well. I would be buying select stocks that you've been wanting to get that maybe move too quickly, and you can protect yourself by taking a position now. And you can always put in a low ball order in case we have a little bit more of the market sell-off ahead of us.
Mark Martiak, how important is the jobs report on Friday? And I ask because we heard comments from Jeffrey Lacker earlier today indicating that he thinks, you know, the unemployment rate's going to keep falling, the labor market looks okay, and that the Fed, for that reason, is going to keep tapering. A bit in the financials helped us turn around here. Does all of that change if the jobs report on Friday is a weak one?
Well, if the report is a weak one, Kelly, yes, indeed, you will see some more volatility creep back into the market. Jobs in this country is clearly President Obama's mandate, and everyone that's concerned with the jobs outlook on Wall Street is constantly focused on this. So my clients often will call before the jobs report or right after the jobs report to understand what the number is. So I tell you that, I share that with you anecdotally because it is so important. And we'll get to know as this week inches closer to Friday how important it will move the markets. But I think it should be good. My own perspective is that we've got a growing jobs outlook, and I think the numbers will bear that on Friday.
From your lips to the BLS ears, I guess, at this point. Christine, since fundamentals suddenly matter so much, let's look at those earnings reports. I mean, yes, earnings have been beating, but the revenue numbers are still coming in pretty light. What do you make of that?
Yeah, we still have about 64% of companies that have reported beating on the top line. However, you're right. Last week, we saw revenue growth had peaked at about 3.5%. This week, we're down to about 2.7%, so a little lighter than we would like. A lot of that has to do with some of the big energy companies that reported at the end of the week last week, missing their revenue estimates. ConocoPhillips comes to mind, Chevron, Murphy Oil. So a lot of the revenue misses have been both in energy and materials. We would like to see that pick up. We really thought the third quarter was an inflection point for revenues. Came in at 4% last quarter. The good thing is the outlook is bright for revenues. We're looking for revenues of 4% to 5% for each of the quarters in 2014. So we do hope that improves.
Tell that to the market, though, right now.
Yeah, absolutely. And we'll see what happens as more of the retailers start to report as well this month.
Exactly.
Thanks, guys.
Thank you, everybody.